Top 20 Common Investment Mistakes. Expecting too much or using someone else's expectations. Investing for the long term involves creating a well-diversified portfolio designed to provide you with the appropriate levels of risk and return under a variety of market scenarios. But even after designing the right portfolio, no one can predict or control what returns the market will actually provide. Nobody can tell you what a reasonable rate of return is without having an understanding of you, your goals, and your current asset allocation. Not having clear investment goals. The adage, if you don't know where you are going, you will probably end up somewhere else, is as true of investing as anything else. Too many investors focus on the latest investment fad, or on maximizing short-term investment return instead of designing an investment portfolio that has a high probability of achieving their long-term investment objectives. Failing to diversify enough. The only way to create a portfolio that has the potential to provide appropriate levels of risk and return in various market scenarios is adequate diversification. Often investors think they can maximize returns by taking a large investment exposure in one security or sector. But when the market moves against such a concentrated position, it can be disastrous. The best course of action is to find a balance. Seek the advice of a professional advisor. Focusing on the wrong kind of performance. There are two time frames that are important to keep in mind: the short term and everything else. If you are a long-term investor, speculating on performance in the short term can be a recipe for disaster, because it can make you second-guess your strategy and motivate short-term portfolio modifications. Buying high and selling low. The fundamental principle of investing is to buy low and sell high. So why do so many investors do the opposite? Instead of rational decision-making, many investment decisions are motivated by fear or greed. In many cases, investors buy high in an attempt to maximize short-term returns instead of trying to achieve long-term investment goals. Trading too much and too often. When investing, patience is a virtue. Often it takes time to gain the ultimate benefits of an investment and asset allocation strategy. You should always be sure you're on track. Use the impulse to reconfigure your investment portfolio as a prompt to learn more about the assets you hold instead of as a push to trade. Paying too much in fees and commissions. Investing in a high-cost fund or paying too much in advisory fees is a common mistake because even a small increase in fees can have a significant effect on wealth over the long term. Focusing too much on taxes. Although making investment decisions on the basis of potential tax consequences is a bit like the tail wagging the dog, it is still a common investor mistake. You should be smart about taxes. Not reviewing investments regularly. If you are invested in a diversified portfolio, there is an excellent chance that some things will go up while others go down. To make sure that your investment still makes sense for your situation, and that your portfolio doesn't need rebalancing. Taking too much, too little, or the wrong risk. Investing involves taking some level of risk in exchange for potential reward. Taking too much risk can lead to large variations in investment performance that may be outside your comfort zone. Taking too little risk can result in returns too low to achieve your financial goals. Not knowing the true performance of your investments. It is shocking how many people have no idea how their investments have performed. Even if they know the headline result or how a couple of their stocks have done, they rarely know how they have performed in the context of their portfolio. Reacting to the media. There are plenty of 24-hour news channels that make money by showing tradable information. It would be foolish to try to keep up. Using the news as a sole source of investment analysis is a common investor mistake, because by the time the information has become public, it has already been factored into market pricing. Chasing yield. A high-yielding asset is a very seductive thing. Past returns are no indication of future performance, and the highest yields carry the highest risks. Focus on the whole picture. Don't get distracted while disregarding risk management. Trying to be a market timing genius. Market timing is possible, but very, very, very hard for people who are not well trained. Trying to make a well-timed call can be their undoing. Not doing due diligence. There are many databases in which you can check whether the people managing your money have the training, experience, and ethical standing to merit your trust. The best case is that you avoid the next Madoff scheme. Working with the wrong advisor. An investment advisor should be your partner in achieving your investment goals. The benefits of taking extra time to find the right advisor far outweigh the comfort of making a quick decision. Letting emotions get in the way. Investing brings up significant emotional issues that can impede decision making. Do you want to involve your spouse in planning your finances? A good advisor will be able to help you construct a plan that works no matter what the answers to these questions are. Forgetting about inflation. Most investors focus on nominal returns instead of real returns. This focus means looking at and comparing performance after fees and inflation. Develop a discipline of focusing on what is really important. Your returns after adjusting for rising costs. Neglecting to start or continue. Individuals often fail to begin an investment program simply because they lack basic knowledge of where or how to start. Not controlling what you can. People like to say that they can't tell the future, but they neglect to mention that you can take action to shape it. You can't control what the market will bear, but you can save more money. Continually investing capital over time can have as much influence on wealth accumulation as the return on investment. It is the surest way to increase the probability of reaching your financial goals.